Japan's finance minister just issued a very scary evacuation warning, but it doesn't have to do with people running away from a special area. It's a financial evacuation warning. You see, Japan has already threatened to dump US treasuries if the bleeding doesn't stop in their own currency. When that happens, your mortgage rate spikes and your 401k cracks the same exact week. And there's not much time left because this is happening right now. Let's check this out.
The most important decision being made about your mortgage rate and your retirement account this month is not being made in Washington. It is not being made by the Federal Reserve. It is not being made by Congress or the White House. It is being made by four people in Tokyo whose names most Americans have never heard. This week, Japan's top foreign exchange diplomat, Atsushi Mimura, told markets, quote, "This is our final evacuation warning." Japan's finance minister, Satsuki Katayama, told reporters the timing for decisive action was getting closer. The Bank of Japan followed both statements, with currency interventions estimated at $63 billion over the last 3 weeks, Japan's first market intervention in nearly 2 years. The yen briefly hit 157 per dollar, the weakest level since May of 1990. They pushed it back below 155. It is now sliding back toward 160. And here's the part the financial press is not connecting clearly. Japan holds approximately $1.4 trillion in US Treasury securities. That is the largest or second largest foreign treasury holding on Earth, depending on the month. On Monday, a finance ministry official explicitly told markets that Japan would not sell those treasuries to fund the intervention. Quote, "Japan has ample liquidity within reserves to avoid touching its US Treasury position." That promise is the warning. That promise is the entire story today. A promise like that only gets made when the alternative is credible. The market asked the question, would Japan dump treasuries to fund the yen defense? Japan answered the question publicly, by name, in writing. The fact that the question needed an answer tells you the market was pricing it as possible. The fact that Japan went to the G7 in Paris today and discussed coordinated currency stabilization tells you Japan is not confident it can hold the line alone. If that promise breaks, if Japan eventually has to sell treasuries to defend the yen, the 10-year US Treasury yield spikes. When the 10-year spikes, your 30-year mortgage rate spikes. When the 10-year spikes, the bond portion of your 401k loses principal value the next quarterly statement. The chain runs across the Pacific. It ends in your monthly mortgage bill and your retirement balance. By the end of this video, you'll understand what the carry trade actually is and why it is the single largest liquidity pool affecting your retirement account, why every dollar Japan spends defending the yen is fighting the gravitational pull of the US-Japan interest rate gap, what the 1985 Plaza Accord teaches about what happens when major economies start coordinating currency intervention at this scale, and the specific damage already showing up in American retirement accounts from the yield rise that has already happened before the next round of intervention even begins. Start with what the carry trade actually is, because if you don't understand it, you can't see where the damage lands. For roughly 30 years, Japan has run interest rates near zero. The Bank of Japan held its benchmark rate at or below 0.5% for most of that period. The United States has run rates between 4 and 5.5% over the past 2 years. That gap, call it 4 percentage points minimum, is the engine of one of the largest financial trades in the world. Here's how it works. A hedge fund, a sovereign wealth fund, an insurance company, an institutional investor borrows money in Japanese yen at near zero interest. They convert that money to US dollars. They invest the dollars in US Treasury bonds, US corporate bonds, US stocks, US real estate, anything yielding 4 to 5%. The spread between the 0.5% borrowing cost and the 4 to 5% return is nearly free money. A heavy iron scale tipping under the weight of silver bars. To borrow Japanese money flowing into US Treasuries is part of why yields have been as low as they've been. The borrowed Japanese money flowing into US stocks is part of why yields have been as low as they've been. The borrowed Japanese money flowing into US stocks is part of why valuations have been as stretched as they've been. Trillions of dollars of leveraged positions face the same pressure simultaneously. When Japan intervenes to strengthen the yen, which is exactly what just happened, every carry trade on Earth gets squeezed at the same time. The dollar assets being sold include US Treasury bonds. Selling treasuries pushes yields higher. The dollar assets being sold include US Treasury bonds. Selling treasuries pushes yields higher. The bond market volatility that preceded Black Monday traced directly back to the dollar management policies the Plaza Court set in motion. Higher yields push mortgage rates higher, higher mortgage rates push housing affordability lower. The chain is not theoretical. It happened in real time in August 2024. The Bank of Japan raised interest rates a quarter point. The yen surged. The carry trade partially unwound. US stocks fell more than 6% in 3 trading days. The Japanese Nikkei fell over 12% in a single session, the largest one-day point drop in its history. The structural pressure didn't go away. It built up again. We're now watching the same setup running into a worse starting position. The structural pressure didn't go away. It built up again. We're now watching the same setup running into a worse starting position. Now to the $63 billion Japan just spent and what it actually bought them. On April 30th, Japan entered the foreign exchange market for the first time since 2024. The first intervention was estimated at $35 billion, according to Bank of Japan accounts reported by Reuters. The yen strengthened from 157 to 155. Follow-up operations brought total spending to approximately $63 billion, the equivalent of 10 trillion yen over 3 weeks. By mid-May, the yen had surrendered more than half its gains and was approaching 160 again.
Hey everyone, real quick, if you are interested in ever buying a house for yourself, refinancing your current home, or buying future homes, I'm gonna throw a link down below to an amazing deal, the Mortgage Master Bundle, 2 courses for investors and homeowners to save, literally teach you how to save thousands of dollars every single time you go get a new loan, and then how to save tens of thousands of dollars because you're gonna get the best rate, because you're gonna know more about mortgages than some mortgage brokers. I'm not joking. You're gonna walk into some broker's office and they're going to go, we don't have that loan. That doesn't exist. And then they look on their phone and they go, oh crap, who are you? They're like, Ninja Nation, baby. All right, let's get back to the video.
Former Bank of Japan board member Takahide Kiyuchi told Bloomberg the intervention was, quote, effective at pushing the yen briefly to 155. Effective spent $63 billion to buy a temporary move that's already reversing. That's the structural problem in one number. Japan is fighting the gravitational pull of a 4-point interest rate differential. Every dollar spent on intervention is a dollar fighting a permanent force that doesn't go away until the rate gap closes. Every dollar spent on intervention is a dollar fighting a permanent force that doesn't go away until the rate gap closes. Now, the damage that has already arrived in American retirement accounts before any new intervention round even starts. Now the historical anchor that matters. September 22nd, 1985. The finance ministers of the 5 largest economies, the United States, Japan, Germany, the United Kingdom, and France, met at the Plaza Hotel in New York City. They agreed to coordinate the weakening of the US dollar against the yen and the German mark. The agreement is known as the Plaza Accord. The dollar fell roughly 50% against the yen over the next 2 years, from 240 yen per dollar to 120. Japan's response to the rapid yen appreciation was to cut interest rates aggressively. Cheap money flooded the Japanese economy. Asset prices, real estate, equities, inflated into the largest bubble in modern economic history. Tokyo real estate at the peak was valued at more than all the real estate in the United States combined. In 1990, the bubble collapsed. Japan entered what economists called the lost decade. That decade became 2 decades, then 3. The Nikkei did not recover its 1989 high until 2024, 35 years later. The Plaza Accords lesson is that coordinated foreign exchange intervention at scale triggers multi-decade consequences that the finance ministers who signed the original agreement could not predict and could not control. The U.S. side of the Plaza Accord story is rarely told. The weakening dollar boosted U.S. exports in the short term, but bond market volatility surged. Treasury yields spiked sharply in 1987. The same year, on October 19th, the U.S. stock market fell 22% in a single session, Black Monday, the largest one-day percentage drop in American stock market history. The bond market volatility that preceded Black Monday traced directly back to the dollar management policies the Plaza Accord set in motion. Japan's finance minister Katayama is currently in Paris today at the G7 finance ministers meeting, building the case for coordinated currency stabilization. The structure is the 2026 version of the 1985 conversation. Different decade, same setup. The interest rate differential is bigger, the debt loads are higher, the energy shot from the Iran war is on top of everything. The starting position is worse than 1985. Now, the damage that has already arrived in American retirement accounts before any new intervention round even starts. The 10-year U.S. Treasury yield is currently at 4.6%. It was at 3.8% 18 months ago. That 0.8 percentage point increase is already showing up in the bond holdings of every target date retirement fund in America. A target date fund holding 40% in bonds, typical for a viewer between 50 and 60 years old, has already absorbed roughly 6 to 10% loss in principal value on the bond portion from the yield rise. That loss is in the most recent quarterly statement. The viewer may not have read it carefully. If the 10-year yield rises another full percentage point from current levels to 5.6%, the additional damage to a 20-year bond portfolio is approximately 15 to 20% of remaining principal value on duration alone. The equity portion of the same fund also faces pressure because higher discount rates reduce the present value of future corporate earnings. A retiree's 401k absorbs the yield move on both sides simultaneously. Bond losses on duration, equity compression on valuation. For a viewer with $500,000 in a typical target date fund, a 1% rise in the 10-year yield from here translates to roughly $30,000 to $50,000 of statement value gone in the next 2 to 3 quarterly cycles. That's the math at the household level if the yen carry trade unwinds further and the Treasury market absorbs the selling pressure Japan is currently promising to avoid. So what should you actually watch? The dollar-yen exchange rate. If it crosses 160, Japan's pain threshold has been breached and the next intervention round is imminent. If it pushes through 165, the question of whether Japan can defend the yen without selling treasuries becomes the operational question of the year. Japan's monthly Treasury holdings report, released by the U.S. Treasury Department on the 15th business day of each month. The data lags by 2 months. If Japan's holdings drop more than $50 billion in any single month, the promise made this week is breaking. The Treasury market will price that in before the data publishes through the 10-year yield. The 10-year U.S. Treasury yield. The number you can pull on Google in 5 seconds. If it climbs through 5%, the equity market repricing follows within weeks. Your 401k bond allocation absorbs each move in real time. The G7 communique from the Paris meeting. If the language includes any reference to coordinated currency stabilization or exchange rate cooperation, the 1985 framework is being rebuilt, which has long-term implications. The G7 communique from the Paris meeting. If the language includes any reference to coordinated currency stabilization or exchange rate cooperation, the 1985 framework is being rebuilt. The next Bank of Japan policy meeting. If they raise rates faster than markets expect, the carry trade unwinds harder. Either decision is a Treasury market decision in disguise. The most important financial decision being made about your household this month is not being made by anyone you voted for. It is being made by 4 officials in Tokyo who are trying to defend a currency against a structural force that is bigger than their reserves. Their promise to Washington is the only thing keeping the Treasury market from absorbing $1.4 trillion of additional selling pressure. The promise holds until the yen breaks 160. After that, the mathematics of the intervention burn rate decide which promise breaks first. You can't vote on this. You can't call your representative about it. You can watch the dollar-yen rate and the 10-year yield, and you can position your retirement allocation knowing the chain that connects them to your statement. That is the entire move available to the household. On Monday, a finance ministry official explicitly told markets that Japan would not sell those treasuries to fund the intervention.